What if I told you the money you're saving right now might be losing value faster than you can save it? Sounds scary, right? Well, today, we're diving into why the global economy is on shaky ground, what Robert Kiyosaki calls a financial collapse, and most importantly, how you can protect yourself from losing everything. From excessive money printing to rising inflation, we're seeing cracks in the foundation of our financial system. In this video, I'll explain why cash might not be as safe as you think and how tangible assets like gold, silver, and real estate could be your lifeline when the markets tumble. Let's break this down step by step. Imagine you're playing Monopoly, and halfway through the game, the banker decides to double the money supply. Suddenly, everyone has more cash, but here's the catch. The prices of properties skyrocket because there's more money chasing the same assets. That's inflation in its simplest form. Now, think about this in real life. When governments print more money, whether it's to fund programs, stimulate the economy, or bail out industries, they're effectively flooding the market with cash. But this doesn't create more value. It just reduces the purchasing power of each dollar already in circulation. Prices go up, savings buy less, and debt becomes harder to manage. Inflation isn't just about higher prices at the grocery store. It ripples through the entire economy, starting with bond markets. Bonds, often seen as the safest investments, become risky when inflation rises because their fixed returns lose value over time. Investors panic, leading to sell-offs and crashing bond prices. And when bonds suffer, the stock market often follows. Companies struggle with rising costs, higher borrowing rates, and declining profits, making their stocks less attractive. This creates volatility, where one day the market rallies, and the next, it tumbles, leaving investors unsure of what's coming next. The result? People start looking for safe havens assets that retain value when traditional investments crumble. That's where gold, silver, and commodities come in. Here's where it gets even more serious. For decades, the US dollar has been the global reserve currency, meaning it's the primary currency used in international trade. Countries hold US dollars because they trust its stability. But trust in the dollar is starting to erode. Why? Excessive printing. Trillions of dollars have been printed in recent years, raising concerns about long-term stability. Rising debt. The U.S. national debt has surpassed $33 trillion, making repayment seem increasingly unlikely without even more printing. Global alternatives. Countries like China and Russia are challenging the system by exploring gold-backed currencies, currencies tied to tangible assets rather than faith in government stability. For example, China has been stockpiling gold reserves aggressively, signaling its intention to back its currency with gold. The BRICS nations Brazil, Russia, India, China, and South Africa are expanding their alliance, aiming to create an alternative financial system that reduces dependence on the US dollar. So, what does this all mean for you? A massive wealth transfer could already be underway. Those who stay tied to paper currencies may see their savings lose value. In extreme scenarios, such as hyperinflation or government instability, there's a risk that the currency itself may become worthless, as seen in historical examples like Zimbabwe or Venezuela. While those who invest in tangible assets like gold, silver, and real estate could preserve and even grow their wealth. Think of it this way. When inflation rises, the value of hard assets tends to go up because they're limited in supply. You can't print more gold or land. Meanwhile, cash sitting in savings accounts loses purchasing power, making it harder to keep up with rising costs. We're seeing this play out in real time. Central banks are quietly buying gold, preparing for a shift away from paper currency. If institutions with vast resources are betting on tangible assets, what should the average investor be doing? The reality is this change is coming. Whether it's the rise of gold-backed currencies, the decline of the US dollar, or increasing inflation, the financial system as we know it is being rewritten. But here's the good news. You can prepare. When it comes to securing your financial future, one of the most important strategies is diversification, spreading your investments across different asset classes instead of relying solely on cash. While keeping some cash on hand for emergencies is wise, parking all your savings in cash leaves you vulnerable to inflation and currency devaluation. Precious metals like gold and silver have stood the test of time. Unlike paper money, which can lose value when governments print more of it, gold and silver retain their worth because they are finite resources. These metals often rise in value during economic downturns and inflationary periods, acting as a hedge against instability. Investing in gold and silver can protect wealth in several key ways. Inflation hedge. Precious metals tend to retain their value during inflationary periods. As the purchasing power of paper currencies declines, gold and silver often increase in value, helping to preserve wealth. Tangible assets. Unlike stocks or bonds, gold and silver are physical assets. This tangibility can provide a sense of security, especially during economic uncertainty or financial crises. Diversification. Including gold and silver in an investment portfolio can reduce overall risk. These metals often have a low correlation with traditional assets like stocks and bonds, meaning they can perform well when other investments are struggling. Global demand. Gold and silver have intrinsic value and are universally recognized. Their demand in various industries, including technology and jewelry, supports their market value. Safe haven. During times of geopolitical instability or economic downturns, investors often flock to gold and silver as safe haven assets, driving up their prices. Wealth transfer. As Robert Kiyosaki suggests, with potential financial collapses and currency devaluation, investing in gold and silver can serve as a means to transfer and preserve wealth across generations. By investing in these precious metals, individuals can create a buffer against economic volatility and protect their financial future. Real estate is another tangible asset that provides both stability and growth potential for several reasons. Long-term value growth. Historically, real estate tends to appreciate in value over the long term. Factors such as location, demand, and economic conditions contribute to this appreciation. Unlike stocks, which can experience significant daily fluctuations, real estate values generally increase steadily, making it a more stable investment. Protection against inflation. Real estate often acts as a hedge against inflation. As the cost of living rises, property values and rental prices typically increase, allowing property owners to maintain or enhance their purchasing power. This characteristic makes real estate a valuable asset during inflationary periods, unlike paper currency, which can lose value. Rental income. Investing in rental properties can provide a consistent stream of passive income. This income can help cover mortgage payments, property taxes, and maintenance costs, while also contributing to overall cash flow. As rental demand increases, landlords can raise rents, further enhancing income potential. Tax benefits. Real estate investors often benefit from various tax incentives, such as depreciation deductions, mortgage interest deductions, and potential capital gains tax advantages when selling properties. These benefits can enhance overall returns on investment. Portfolio diversification. Including real estate in an investment portfolio can reduce overall risk. Real estate often has a low correlation with stocks and bonds, meaning it can perform well when other asset classes are struggling. This diversification can help stabilize returns and protect against market volatility. Active management. Unlike stocks, where investors have little control over company performance, real estate investors can actively manage their properties. This includes making improvements, adjusting rental rates, and selecting tenants, allowing for a more hands-on approach to maximizing investment returns. Physical presence. Real estate is a tangible asset, providing a sense of security that intangible investments, like stocks, may not offer. This physical presence can be reassuring, especially during economic downturns when confidence in financial markets may wane. Consistent demand. The demand for housing and commercial properties tends to remain strong, driven by population growth and urbanization. This consistent demand can help ensure that real estate investments maintain their value over time. In summary, real estate serves as a robust investment vehicle that not only offers the potential for appreciation and passive income, but also provides a safeguard against inflation and market volatility. By diversifying into real estate, investors can enhance their financial stability and protect their wealth in an ever-changing economic landscape. For even broader protection, consider investments in commodities like oil, natural gas, and agricultural products. These are essential resources, and their value often increases during periods of high inflation. Follow global trends. Pay attention to what countries like China and Russia are doing to secure their economies. Stay informed by continuously watching Finance for Earn as we simplify complex economic issues. Knowledge is power, and understanding how these shifts affect your money will help you make smarter decisions. History has shown us time and again that empires rise and fall, currencies come and go, and wealth shifts hands. Those who prepare early often emerge stronger, while those who ignore the signs are left struggling to catch up. The question isn't whether this change is coming, it's how ready you are for it. Are you protecting your wealth, or are you leaving it exposed to inflation and devaluation? Now is the time to act. Take the first step by investing in assets that last, because when the financial landscape shifts, you'll want to be standing on solid ground. What's your plan for securing your financial future? Share your thoughts in the comments, and let's keep this conversation going. Don't forget to like, subscribe, and hit that bell icon for more insights like this.